Hello, everyone. Good afternoon or good morning to those on the West Coast. My name is Leslie Benjamin. I'm with Strategic Compliance Partners. We are a compliance management solution for lenders and brokers, if you don't know who we are. Today, Ari Karen, he's a partner with the Alpha Kerman Law Firm, as well as our CEO. He's going to present on the future joint ventures. He will be taking questions, so there is a questions pane within the GoToWebinar platform. So just write in your question there, and if we have time to answer it during the presentation, we will. If not, we'll follow up with you after the presentation. So with that, I'm going to hand it over to Ari.
Great. Thanks so much, Leslie. And hello to everybody. So this is funny. Literally right before I got on this, I got I get these emails, and I think it was Inside Mortgage Finance. I think that was the publication. I don't want to misquote it. I think it was that one. But and there was an article in it that talked about how MSAs, are very uncertain even after they didn't mention the PHH case or anything, but they just said how even though courts have sort of rejected corduroy, we're not really sure where we stand with MSAs. And it's kind of funny because that's exactly where I was going to start our presentation. So Leslie, can you go to the next slide? So one thing we're going to talk is just about PHH. So just to get background, what the court decided in PHH, and I think this is important to this whole discussion, is two things mainly. First, with respect to is the CFPB constitutional? Well, they said the CFPB was constitutional. They also did it in such a way that we could have a change. We've all seen the sort of dynamic in the shift of the CFPB under Trump and under Mulvaney and kind of where it is now, which is quite different from when it was under corduroy. And some people thought, oh, well, good, we're set for the next 5 years here. And I would say not so fast. Because if the presidency changes in 2020, I guess is the next election, right? Then we could be easily sitting there with a different president, or not. Who knows? But assume it just for the worst right now that happens, or the best, whichever way you look at it, that it is, and you're going to have a different change at the CFPB. This is not a 5-year appointment anymore, because the court eroded the concept of for cause so much to the point that it almost doesn't matter. They basically said a president can do what a president can do, and whether you say for cause or not in this context, the way it's written, it doesn't really mean for cause. So president can do whatever they want. So that's how they found it constitutional. I also think one thing to remember is, another federal court has just struck down the CFPB as unconstitutional, and that was a New York court. Now, that could go to the Supreme Court. What's really interesting about that, Kavanaugh, the new Supreme Court nominee, is the one who wrote the 3-panel opinion at the DC Circuit before it went to the full panel, and he wrote the opinion determining that the CFPB was unconstitutional. So it's very interesting now that if that case goes to the Supreme Court, you've got one person who clearly believes and has already decided that assuming that Kavanaugh gets, approved, of course. Again, lots of assumptions here, but just kind of an interesting setup. My point is, I think ultimately it doesn't really matter because it's sort of two roads leading to the same destination. Whether you say it's unconstitutional or you say it's constitutional because for cause doesn't matter, you still yield the same result, which is that when the presidency changes, the CFPB can change. So remember that, because I think that goes a lot to what's the future of MSAs. The future of MSAs is sort of very much open and in doubt, because if you go to the next slide, Leslie, if you could hit the next one, then what you see is that in terms of the actual interpretation of RESPA, the court sort of bounced the whole question. They so limited it. First of all, they said this particular case only dealt with MI or actually reinsurance for MI. It doesn't impact loan cost to the consumer. At the time, the reinsurance was a captive market, and they actually said they literally limited the holding when it came to RESPA to the holding of the third, and stated that the holding was that, quote, Section 8 permits captive reinsurance arrangements so long as mortgage insurance pay no more than reasonable market value. That's such a narrow holding, and that's pretty much what they did. I mean, you could argue it was more expansive than that. I mean, there's arguments both ways, but the bottom line, if somebody wants to take a narrow interpretation on PHH and say, we don't think the court ruled that and they want to go expansive, there's plenty of room and plenty of ways to do that. So I think we don't really know much really about, next slide please, Leslie. I don't think we really know much about the future of MSAs. I think we're kind of left with the guidance of MSAs. And I'll mention those only for a moment just to kind of give us a platform on which now to talk about joint ventures. So what can you do in MSAs? I mean, I think that based on the guidance, based on things that have been written, I think there is a lot of gray area when it comes to MSAs. I'm not one of these people who says you can't do them, and I want to be very clear. I've said that all along. I think they can be done. I continue to maintain they can be done, but I think they have to be done in a very specific way. And then I think you need services that are going to be directed at consumers, not other settlement service providers. So the MSAs that basically provide, that, oh, we're going to get to, have a Friday afternoon happy hour with all of your real estate agents, I don't know that those fly. And I think pretty good arguments can be made against them. And I think they have to be audited constantly to make sure that you're getting the things you say you're getting and you're paying only for those things you're receiving. And I think also the fact that a third party sets a price doesn't simply mean, okay, well, it's fine. If that price somehow is well, whether it's based or not, I mean, obviously if it's based on getting referrals, that's a problem. But I don't think it ensures rest of clients. I think it is a necessary aspect to what you do, but I don't think just because you do it, if somebody values and says, oh, it's worth X to you to have Friday afternoon happy hours every happy to meet agents, I don't think that makes it not a potential RESPA violation, especially given that we have such uncertainty around that. So when they're done the right way, you set them up with front-facing services. They face borrowers. They're specific and they're tangible. There's something you can point to saying they did this for me, and I'm paying them for doing that. I'm paying them for putting that link on my website, and there's a value for that. And things like that. But when you get to some of the stuff people want to do in MSAs, it starts getting shakier for me. So, and I think in all MSAs, you have to have written disclosure. That's critical. Next slide, Leslie. So,
sorry.
So, I mean,
I'm a little technical difficulty here with the slides.
Okay. So, where I think that leaves us, and I'm just going to keep talking while Leslie's doing that.
There we go.
Is that, I think you have to avoid, the purpose of MSAs, like this slide says, is really not about networking and sponsoring. I think those are things you can do, but they should be separated. They should be on an event by event, pretty much an event by event basis with some legitimate underlying market-based valuation for them that is kind of similar along the lines to what other industries do. I think something like that, you can do some of those things, but for the most part, you want to stay away from them in your MSAs. Next slide, Leslie. So really where I think that takes us to is the idea of now, let's go to talk about joint ventures. So let's see, why don't you jump past that one, if you don't mind. So I'll talk about joint ventures for 1 second. I mean, the benefit of joint ventures is that it's more predictable. In other words, while we have this general gray area, I mentioned some things you can do and you can't do in a second in the MSAs, when you get to joint ventures, there's actually a good deal of case law. And there's case law that specifically says not only you can do it, because there's just no question about it. It's actually written into the statute. I mean, not JVs per se, but that the fact that there's ownership, these types of affiliated entities, they're permitted. There's not even a question of whether they're permissible, right? The question is whether you're setting up as a sham. So there's actually a test for a sham transaction. But what's funny is that test may not even be necessary because of some rulings. So in other words, as opposed to MSAs, where there's literally nothing that explicitly or even implicitly really says you can do MSAs, there's a real tangible case law that talks about JVs that says you can do these types of entities, third-party entities. And so you start from a place of a higher degree of predictability. Certainly there's some higher risk. We'll talk about that. Before we get there, I just kind of want to just close the door sort of on MSA discussion really quick. I mean, let's talk about the things that you have to do to set up an MSA. And think about this, because I think some of the reasons people say joint ventures are not the way to go is there's so much work. And I guess what I want to say is, I don't know, there's so much work more than what you have to do with an MSA. Because with an MSA, you have to document the rationale for the fair value. You have to proceed procedures for management of not only the way the MSA comes in, how it's negotiated, how it's reviewed. You have to audit the MSA constantly to make sure that that the services are actually being provided. You have to have a valuation for it. You have to do things again that are very direct and consumer facing to base the value upon. With that valuation, again, market based. You of course have to disclose the business relationship to consumers, which you have to do with the JV too. And you're going to have to document all the payments to outside of the MSA, if there are any, and have explanations for those. So if you're doing the sponsorship, it's all got to be documented. And if you have any changes to it, which you really need to avoid, you really want to document those changes. You also, in terms of the don'ts, and I asked Leslie to pass that slide, she doesn't have to put it back up, it's okay, but what are the ones you want to avoid is exclusivity. What's one of the big ones you want to avoid? You don't want to have an exclusive relationship, anything that says that. So there are certain drawbacks to it. I mean, you're paying a set amount of money, and you're paying that no matter what, as long as the services are provided. It's not linked to referrals, none of these things are happening. And then, let's kind of juxtapose that a little bit against what you could do with the JV. Next slide, Leslie. So, I mentioned some of these. In some ways, I think because with the JV, you're going to have when we talk about JV for clarity, I think we all know this, but I'll just point it out. You're talking about a third-party business entity. It's a separate business, okay? No ifs, ands, or buts about it. We'll talk more about what some of those indicia are. But because it's a separate business, in many respects, once you set it up in a certain way, it is more manageable because there's an operating agreement, right? There's literally a set document that the owners, have that talks about how this is going to be run. In those ways, it's a lot better in some respects than an MSA, because with an MSA, you don't have a set way it's run, right? There's a deal and we pay you X per month and you're going to do Y and that's that, okay? A set third-party entity. The other thing with an MSA, think about it, the risk directly runs to the company. If you as mortgage banker X have an MSA with Realtor Y, okay, and that MSA, creates a problem, the liability immediately rests with lender X. In a JV, if you set it up right through a holding company, et cetera, the liability should stop, if you do it correctly, with the JV lender, the broker, if you will, or whether it's if you decide to set it up as a correspondent, you could too. I always set it up, at least originally, as a broker. So I think you actually have a vehicle if you do it correctly. And I keep saying if you do it correctly, because here's the thing. This is where it really goes wrong for a lot of lenders, and the reason why so many people just want to stay away from JVs. People do it wrong constantly. They don't do it wrong frequently. They do it wrong constantly, okay? I'll talk about all the places and all the ways in just a minute, but I think I'm not going to say every single time it's done wrong, but I'd say almost I see that, if not at the outset, certainly over some period of time, the way it evolves. Going back to some of the benefits of JVs, I think that you also can use it for other solutions. So, for example, let's say you want to be able to broker out certain kinds of loans. You don't want to do it at your company because of the problems with compensation. You could literally have brokered loans be done by the JV. So let's say you don't have you don't want to deal with the compensation issues with brokered loans. So you could put those over at your JV partner. You could have a different compensation plan, obviously, at your JV partner. And if your JV partner brokers the loan that you otherwise don't want to broker because of the comp issues, you could do it much more cost effectively at your broker, your third-party JV broker, and just have those loans go through that direction, that channel. I mean, it's a good outcome, right? And it doesn't create any issues with your compensation. You don't have to deal with, referrals and this and that. So you really could use that. You could also use it for a retention desk of sorts, right? I mean, if you miss a loan and your broker comes back, a separate company, your JV, and starts targeting people, as long as, again, you have to set it up correctly, get your privacy set up correctly, do all these things, there might be a way to do it. And then I think one of the other keys, though, and this is, I was saying this a minute ago, I referred to it or alluded to it, you know, how things evolve. One of the huge things, and this is what I think people miss when they set up JVs, is to set it up to be long-term compliance, not just at the outset, but so that there's a way to sustain that focus on compliance that often exists in the very beginning of the MSA, but gets forgotten when, you know, you're starting to talk about dollars and cents and bringing in revenue, and, you know, it's been set up and it's been operating for 2 years and it's starting to gain some traction. People start to forget about the compliance, and that's when the wheels come off. I mean, if you look at a case, and I don't want to make, you know, point anybody out, but it's that prospect mortgage case, right? We all know some of the things there were aggressive, let's just say, and I'll put that in air quotes, okay? But, you know, paying the realtors, you know, taking video, you know, iPhone videos of realtors being paid $20 for lenders in open crowds for every loan they referred. Obviously not ideal, right? Okay, to put it mildly. Do you think anybody set up you think a lawyer set up this JV with the idea they were going to do that? Of course not, right? That wasn't set up for that reason. You asked anybody who was involved in setting this thing up, say, hey, is this a good idea? They would have told you, no, absolutely not. But as it got bigger, as people got distanced from compliance, as compliance got forgotten, and it evolved and evolved and evolved and evolved, eventually you ended up at the other side of the spectrum where they're getting in trouble, and guess what? I don't think there's that JV anymore, if I'm correct. So I think that's the type of thing that you have to be careful of when you set these up, because many times that's where the failure occurs down the road, not even at the initial setup. So the key is to set it up in a way that inherently the compliance is sustained by the setup, sort of like the way they set up the U.S. Constitution, right? It was a kind of a living document. It's obviously differently set up, different kind of issue, but in the structure, it was built in such a way that it would continue to progress. It was inherently set up in that way. And I think you've got to think about that, not just setting up so you have an operating agreement that's going to live, breathe, and work in such a fashion that down the road it's going to sustain and maintain that compliance inherently by how it's being done, with some other pieces put into place at the beginning. Next slide, please.
Ari, we got a question in, and I think it was a little bit before. It was, do you have a specific case I can refer to for the case law mentioned?
Case law mentioned what?
I think maybe in the previous slide, the person who wrote this in, if you want to clarify a little bit, we can come back to it.
I'm not sure the question. I'm sorry, I don't really follow case law. I mean, the only case I think I mentioned so far was the prospect mortgage case. It was the consent decree.
It was before that the question came in, but okay. So a case law for the MSA permissible. May have been the Sixth Circuit on sham.
The only case, the other thing I was referring to, the PHH case, the PHH decision, or they're saying the New York case. If it was the New York case, I don't know the name of the site of that case off the top of my head. I just know it was about 3 weeks ago, 2-3 weeks ago. If you Google New York court, PHH, or not New York court, not PHH, New York court, RESPA, CFPB, or not just New York court, CFPB unconstitutional, I think you'll find the case. Sorry, I just don't know off the top of my head at this moment. With respect to the JV risk, we talked about some of these also. So why don't we just go to the next slide? So one thing I also want to point out, and I get this question a lot. I will not mention any names for obvious reasons because I don't want to, it's not kind of what I want to focus on. But one thing I get calls like, oh, well, can't we just do a franchise? The answer is no. And guess what? When people say they have a franchise, if you actually look at some of those, and I urge you to do that if you think, oh, no, I know company X definitely has a franchise. Look at that alleged franchise. Remember, franchise is a legal term, right? It's not just like, it's a franchise. There's actually a legal definition, and there are legal statutes pertaining to franchises. And Every state has them, and there's all types of laws about this, right? What people have set up are not franchises. They may be repetitive business models that get redone over and over and over and over again, right? And they may have certain marketing that is similar, and they may even have certain partners that are the same. But each one of those companies is, and has to be, by the way, separately licensed. They have to have separate everythings, right? Separate ownership, separate capital structures. It's not a franchise. So what it is essentially a business model that is just being copied over and over and over and over again. That can be done in a JV, but they're going to be differently licensed. They're going to have different control people. They're going to have different names, and even the ones that say they're the same, look at the names carefully. There are always little differences in the names. There might be a similar aspect of the name, but they're not going to be the same. Okay, that's really critical. So just, this idea of franchise, that's easy. I have not seen it done, and I don't think it actually can be done. Some elements of what we perceive openly as a franchise might exist, but they're not franchises. Next slide. So the pros, really, one of the big ones, I think, with the joint venture, besides what we've talked about, is, you can't get around it, right? It's the profit sharing. It's simple, right? If you own 50% of the company, or you own 49% and I own 51, you get 49% of the profit. I get 51% of the profit. You're the realtor, you bring in a loan, and the loan results in $1,000 of profit, and you're the owner, obviously the MSA with me, and you're getting 49%, you get 49% of that profit. It's not a flat payment. Like it or not, and maybe I shouldn't say it so explicitly here, but you're revenue sharing, right? You're sharing for every dollar you bring in, you're getting a percentage of that, to the extent, obviously, it goes to profitability as an owner. So, that's what your goal is. It hits exactly what you're trying to do, right? There's no, well, I'm going to pay $5,000 a month, and it's nice and everything, but it's not like this, right? This is explicit, it's direct, it is what you're trying to do. It's what you want. You want to pay, it's better than a quote unquote, I'm going to use the bad terminology, kickback, because it's percentage of every dollar you bring in. You get a big chunk of it, depending on what you negotiate in terms of percentages. So the other thing is, if you, this sort of revenue sharing is just the way it works. So there's no need to audit every single dollar and every single, event that anybody does to generate that dollar, and did somebody provide those services. That's all gone. It's just the operation of the entity. That's how it works. The con to that, okay, is that when you look at it's a long-term solution. You're stuck with your partners, and you can't change your percentages, right? We'll talk about that later. If you've got a deal 51-49 and you capitalize the company in that same percentage, which is the only way you can do it, so the capitalization has to meet the revenue sharing proportion, just like in a typical business it would, then those are your partners, and that's your deal, and you're stuck with it. So key one is know your partners well, right? Don't just do this with anyone. I will say one of the benefits of an MSA is that if it doesn't work, you terminate it at the end of the 6-month period or whatever, and you move on and you're done. And there's no harm, no foul. It's easy to set up. It doesn't cost much. This is going to cost some time. It's going to take some time and work, and you'll have to spend some money to set it up. And, you don't do this with just anybody. It's a larger investment in time and cost, which goes back to my point, why compliance is so critical and so often overlooked in terms of a long-term plan. You're not going to make your money back in a JV in 3 months or 6. It might not be a year or maybe 2. It's a long-term investment that you want to be operating for 5 and 6 and 8 years. And so if you set it up without any compliance control, which is what's so critical to it, or don't think about that in the setup long-term, by the time you're getting your payoff for your investment in that, you're at massive risk to lose the whole thing, right? So it's got to be a really big component of it that people overlook, because it is a long-term strategy, not a short-term one. So any long-term strategy, you have to put more control and protection in. And that's the piece I think a lot of people forget when they do it, because to make this work, it has to work long-term, has to. Otherwise, by the time you get paid off, it's going to be over. and maybe you're going to end up giving back a lot that you got in the interim to pay you back because you're going to have an enforcement problem, right? So, because let's be honest also with these things, you will be. It's not like look, you do an MSA, maybe you'll audited, maybe you won't be audited, chances are probably, but, maybe not. You're going to be audited. You're going to be examined. You're going to be under scrutiny. There's not a 90% chance of that. There's a 100% chance of that. You will, because of the power of it, right? I mean, the fact that it does exactly what you want. It's the profit sharing. That is a very strong, persuasive thing for a realtor to send business. And so given that and the effects it can have in a market, you're going to be examined with certainty. So get yourself ready for it right now at the outset so you don't have problems you have to fix. They may not let you fix them. Let's go to the next slide.
Ari, someone just clarifying that it's not revenue sharing, it's actually profit sharing.
Well, that's true. That is, I should say, profit sharing. You're right, profit sharing, not revenue sharing. Revenue ultimately gets to profit if you're running your business well, because obviously your revenue, you're getting a percentage of that in profit. So yes, it is profit sharing. That's correct. Let's talk about now some of the do's and don'ts. With respect to your joint ventures, you have to keep, first of all, you have to keep separate everything, okay? So you have your business, and you're not going to just simply duplicate the services of business one, the parent, let's say, in the subsidiary of business two. Now, I understand that they're both going to be mortgage bankers, but you're not going to perform all the functions for that subsidiary business in mortgage one. So in other words, people call me all the time and say, oh, well, why can't I have all my marketing done and just do a shared services agreement? I'll have the marketing done and the processing done, and I'll do all of the HR and the accounting, and everything will be done by business two, but within, through a shared services agreement with business one. That's a sham, okay? You're just duplicating. I mean, you're not even duplicating. You're just saying, well, this applies to you, and you're using all the same people, the other business. You have to have distinct, non-duplicative service providers or people doing the services at your subsidiary entity, the JV entity. You mean that obviously goes along with it is maintaining separate staff and having separate internal functions. Now, I will say that there are some limited aspects there I think you can engage in certain shared services. They're not critical to the core functions of the business. So, for example, if, let's say you have a mortgage bank that owns a mortgage broker, the mortgage broker should market themselves. The mortgage broker should have its own processing. It should have its own loan officers. It should have at least access to its own version or portion of an LOS system that would be consistent with a broker. You want all of these things, not just borrowed or being used. It's distinct, it's separate, it's in a different company, it does different stuff. They're not employees being shared back and forth, none of that stuff, okay? Now, could you have HR and accounting, maybe information technology on type of some arm's length shared services agreement? Yeah, I think stuff like that. They're not critical to the functioning of the core of that business, right? That's what we're talking about here. You want to compete in the marketplace. I talked about marketing, to show you have a viable, legitimate entity. You don't want that entity simply to be making the money that gets handed to it from the realtor, or not the money, but the business that gets handed from the realtor exclusively. Now, I realize that might be, especially when it starts, the lion's share of what it's making. And you know what? That's pretty normal and doesn't surprise me. But from the outset, they should be doing things that show the intent, the expectation, the desire, and the effort, more importantly than anything, of getting separate business from separate places, compete in the marketplace as a distinct entity. That undermines the concept that somebody might want to say, hey, this is a sham, and it's only a way to cover referral payments, right? No, it's actually a legitimate standalone business that's marketing and trying to get its own business. That's a huge, huge thing. It also, everything should be disclosed. And when I say disclosed, I don't mean once. I don't mean twice. I mean over and over again, okay? So I mean, the way I would put it up is I would say you want the realtor affinity partner to disclose it at the outset, disclose it when they refer the person. Then you want the JV to disclose it again, like at least 3 times, okay? Because there's no harm in it. And, you know, that's one thing that I find kind of interesting, because there's a really good way. Obviously, you want to do the exact words of affiliated business disclosure, but I think you can also add to it and almost make it a sales pitch, a sales promotion from the very inception of the relationship, where you can say, listen, you know, you're about to undertake one of the biggest financial transactions you might ever engage in your life. And at the same time, you're going to get what's the equivalent of a, you know, physical exam, okay, with your respect to you financially. You're going to undergo, you know, lots of questions with lots of documents, ask every question. Like, at the same time that you're taking on this huge financial, not necessarily, well, risk and investment, right? You're also going to, at that same moment when you're going through all the stress of buying a house, you're now going to have to go through the stress of getting the financing for it. Now, look, you can use 2 different people. Wouldn't you rather just do it with one, with people who kind of know the whole deal and we work together all the time and we're consistent with how each other works together and kind of how we do things? And doesn't that sound better? It does to me. It's not a hard sale. I'm not a mortgage banker, but that would be pretty effective to me. And in selling it, well, again, that is not your ABA disclosure. There's a form. We all know there's a specific form, and I'm not saying to replace that. But the point is, you can be out front with it. And that's what I advocate strongly. Be out front that you're the same company. Be out front with the advantage. Tell them, like, but hey, you can work with anybody, but that's why I think it's best, right? And if they agree with you, you've avoided this whole issue that gets people in trouble. Another big do is maintain consistency in ownership. You do not want things switching around. Then you're getting to referral payments. Why is that so key? Because it kind of goes back to that point I said about let's just say you have a scenario where you are constantly switching it around. What's going to happen in that situation is that you're going to be able to match the referral percentages of the business partner to their level of ownership and profit sharing, which would clearly be a RESPA violation. By having it, situated and permanent, if you do no business, in other words, if you're the realtor partner, you don't bring 1 loan in, you're still getting 49% of the profit in my scenario, right? That's the risk that you take in doing this. It's the risk why you have to invest and make sure and be careful and all those things, what you do when you start a business, right? But it's also the reason why this is lawful. It's also the reason why, it's not just going to be about referrals and things like that, because you're going to have to pick partners that you trust to be in business with, because it is a business. It's a third-party standalone business. You want to have also, along with that, different locations and different market presence. As I said, distinct marketing. Don't use the same marketing. Go at business a different way. Have a different marketing people. Work on it a different way. Don't just use the other company's resources and make them your own or style them your own. You want it to be distinct. And you're not going to be in the same office. You want them to be distinct locations. Now, again, you might start off with some location that is close to, maybe in the same building. Okay, that's not, but make sure it's distinct. 4 distinct walls, distinct address, distinct everything, right? Make it look, feel, sound, act like a distinct ownership. And sort of all the don'ts.
Ari, before you go there?
Yes.
We got 2 questions, so I'll just throw them out to you. In your opinion, is it compliant to have a correspondent or TPO arrangement with only the mortgage banking partner in the business? And then there's a second question after that, too.
That, I don't think so. And let me add something, which is I mentioned before. One way you can actually kill 2 birds with 1 stone and actually improve your compliance and help you is, let's just say you don't have a good channel for, I'm going to make it up. Okay, you don't do construction loans and you broker them now at your company, right, at your mortgage bank. But it causes problems because of LO comp with those deals, and you're not being paid enough on the brokered deals to pay the loan officer 150 basis points. So now you have to pay differently, but then it's steering, like that whole thing, right? I won't go into it too far, but you get the conundrum. I hear it all the time, and I'm sure you guys are familiar with what I'm talking about. So what if you were to take that and say, listen, I'm going to avoid that issue. I'm going to throw it over to a different company now. I'm going to set my broker, and my broker now my broker company, right, is now going to do the brokered loans to a different company altogether. They're not going to broker them to me. They're going to broker them to somebody else, which you don't do anyhow. So you wouldn't be getting them through TPO. Think about that. You just solved two problems. One, you created a channel separate and apart from you for your broker, creating its and reinforcing its legitimacy and independence. And you took a problem out of your own wheelhouse and put it somewhere else where it's not a problem anymore. You can do that, and I think that's a great way to handle it. So you're kind of helping yourself both ways. That's one strategy. Obviously would work the same way with the correspondent channel too. So I think you want to avoid all of the loans, but I think you can set it up where there may be loans that you typically wouldn't buy or you wouldn't do, and you let your mortgage banker, or sorry, mortgage broker slash correspondent handle those types of things instead of being at the parent company. That's how I would do it most of the time, and that avoids the real issue, which is you don't want to be giving away that revenue. If you don't have to, you're going to give away revenue you weren't getting anyhow, or didn't really, quote unquote, want terribly anyhow, but you sort of had to for other reasons. So that's how I would kind of use it and kind of do that. So there's another question, Leslie?
Yes. If there is no common ownership between the two parties, is an affiliated business disclosure required?
I'm hesitating on that because there's something wrong with that scenario that I mean, if there's no common ownership, then where's the, there'd have to be common ownership somewhere. So maybe someone wants to send me an email afterwards and explain that a little more. There's something that's missing in that question to me. And by the way, even if there was no common ownership, maybe they're going with some type of husband-wife concept. Why? I mean, really. You're begging for a problem, right? Borrower comes and says, I was steered. And they didn't tell me that the husband owned it. That's the only place I'm going with this. That's what I'm thinking maybe somebody's getting at. Is it illegal? I don't know if you have to give, but why wouldn't you? Right? Why wouldn't you disclose that? Because every time you don't disclose something, yes, maybe you can win that argument. Maybe you should win that argument. Possibly, but the problem is now you've consumers who are upset, you've got regulators looking at you, they're going to scour all over you because they think you're getting around it. What's the big deal of disclosing? If I had a husband wife, I actually had a situation like this one time. I remember telling him, so you actually could say, the husband is the realtor, and I actually said to the realtor, why don't you just tell the borrower or your client, like, hey, I know the loan's going to get done if I give it to this person because I sleep in the same bed as her, and it's not going to go very well for me if the loan doesn't. You know what I'm saying? Like, why wouldn't you say that? I guess I messed it up. The husband was the husband was the lender. The wife was the realtor. But you get my point, right? Like, let's disclose. Everybody has a good laugh. They probably feel more confident, not less, about this now. So disclose. I wouldn't get around. Not sending in ABAs is never going to look good, right? Because that's what people want, is that disclosure. It's that fundamental fairness that inherently everybody understands the real situation. So even if you get around this, I wouldn't get around this. I'd embrace it. I think that's the way to go, which if you're doing something as aggressive as this, because it is aggressive, you want to be, the name of the game here for long-standing compliance isn't to do the minimum. It's to do way past the minimum. And when you do that and you set it up in a way that's really conscious of that and that allows you to still do your business, you can actually be more aggressive with it because you're playing inside the lines. When you play those like cloudy, that's when you get in trouble, because as soon as you step out, there's something waiting for you, right? They're just sitting there waiting like the cat. Now, I know he's going to make a mistake. Oh yeah, here we go, right? Don't ever put yourself in that position. You're doing a really aggressive, a very good, a very effective business model that in many respects is, let's be honest, violating the spirit, but you're allowed to do it. So do it really well, and that's what's going to keep you in business a long time to make this payoff work. Next slide. So I mentioned this HUD 10-factor test. The thing you want to remember at this test, and if you Google it, or you'll probably find a Sixth Circuit case that, and maybe some others out there that said you didn't have to apply this 10-factor test. Now that's one opinion from one court that There are what, 11 other circuits. So, you know, what are they going to rule? I don't know. And again, why would you find out? Because to the extent, you know, you do something that looks like a sham, it's going to tend that a court will find it to be a sham, whether the HUD 10-factor test is applied or not. So again, with the concept of we're going to do everything we need to do to make it a standalone business and all these types of things, we're actually going to follow the 10-factor test. And this is a totality of circumstances test, okay? There isn't one factor that gets you in trouble. It is totality, as I said. But the way I look at these totality of circumstances tests is that there are going to be areas where you're going to want to deviate from the test, where you're going to say, look, this is too much of a business challenge. So for example, when we talk about functions like HR and accounting and information technology, to reestablish those with a new entity, that's really, really expensive, time-consuming. There's no return on investment. Like, you don't want to do that. That's where you take your shots. That's where you set this thing up in such a way that, you know, I'm doing everything else perfectly, better than perfectly. So I'm going to be a little more aggressive there, and I'm going to share those services. But I'm going to have contracted payment arm's length. We're going to figure out it's not just going to be for $1. We're going to have a valid cost effect, you know, when we're going to write it up, and it's going to be all done, you know, above board and properly, all that kind of stuff. Now you're like, okay, that works. But you're not going to contract over the loan officers. Then you're starting to get to the sham, right? So you want to avoid that. But I think there are places that the better, when you can do things separately, do things separately. And when they go to things that are core to the business, keep them separate. That's why I think the loan officers, and I know people would take some issue about the marketing. It's just, I feel like that given what's at stake here, it's such a good place. And there's also a reason why I don't like the marketing shared is the mistakes are deadly. Okay, in other words, you're using the same marketing company, so you got your marketing company and the parent company, right? And we're going to talk now about the real world, not a lab experiment, right? Because that's where we live. And they're doing, you know, they're doing all this stuff, and they're doing their marketing for company X, and they send out an ad for company Y. But at the bottom footer, it still says the NMS ID for the first parent company. But it was sent out under the second parent company's name. Uh-oh. You a different entity now? You see, I mean, things like that, or, you know, the font all looks the same and they just change a word, but it's the same exact advertisement doing the same exact thing. Are you the same entity? Like, those are things where you go in front of a judge, I don't know what happens. It's sure something that you wish didn't occur, right? I mean, of course. So I think you've got to really think about that. Think about, because those mistakes will happen. No one's going to catch them. They will happen again and again. And one day you're going to get an exhibit to a lawsuit that has, you know, 15 things, okay? And you're going to be like, oh, how did that happen? I wish I had. Don't be in the wish I had. Because again, the fines with this, if you lose and you get it wrong, they're big. I mean, they're a lot worse than an MSA, right? Because think about how much money is potentially involved in this. So the risk is much higher, but it's why you have to be more careful and do it in a more predetermined way that is more certain to be compliant. Next slide. And I sort of already addressed this one. So yeah, the one thing I always tell people, this kind of last point, that last bullet point, I always put yourself in a situation like, I want you to really close your eyes and imagine you just got a letter. And tomorrow, CFPB, Department of Banking for your state, whoever it is showing up and going to audit you. And you're going through your stuff. Are you going to sit there and say, oh man, I wish I had not done that. I wish I'd set this up differently. People often set things up saying, oh, well, it's going to be a couple years before I'll be audited. I'm not going to worry about it. We'll fix it before then. It never gets fixed, by the way, right? Because you don't become more compliant. You usually become less compliant as you get away from the operation, from the operational start point. Just don't be in there in a scenario saying, God, I wish I'd done this, because that tells you you made a mistake, right? You want to be in a place where you're confident they're coming in. Okay, they're coming in. Yeah, I don't really want to deal with it. It's always going to be a little anxiety, but set it up and you're confident. You know you did what you did and you did it right. That's really the litmus test here, because there is so much risk inherently starting something this. but you have to do it right. And it's just like anything, right? Driving a car, taking a roller coaster, getting on a plane, you name what it is. Any of those things can end in disaster, right? Any of them. But if you know what you're doing, you're safe, and you're doing the right things, usually it works out pretty much okay, right? And this is sort of the same thing. There is a path. I think it's a clearer path, frankly, than MSAs to do it and to do it right. You've got to follow it. That's the key. Next slide. So these are some of the considerations. You know, we are getting a little bit light on time here, so I want to keep going. But, you know, make sure, you know, your licensing and your agency approvals, that's good, you know, are all good. You want to make sure all your disclosures comply with RESPA's format. You want to make sure your shareholders agreement, this is really critical, you know, is well set up from the start. You want consistency in ownership, investments, P&L, we mentioned that. You really want to select the duties and who's going to be the manager, what the board of directors is going to do. One other thing I think is critical, can you go to the next slide, Leslie, is to set it up in such a way that, that you're going to be able to enforce some of these rules at your affiliates. So in other words, in an operating agreement, I would you know, remember the affiliates are affiliates of the owners. So if the owners have control over or you know, sufficient interest in the affiliate entity, then by definition, they should be able to enforce certain things at the affiliate entity. So if I'm an owner A and you're owner B, and I say, okay, I'm going to sign this, and one of the things I'm going to represent is that my affiliate entity, I'm going to make sure they take training. Well, that is not necessarily incumbent on the affiliate itself. It's incumbent on the owner of your entity who has to take that action to be in compliance with the operating agreement he's signing. I would get control over the affiliate actions in that regard. And the more degree of control, depending on how aggressive your model is and things like that, I think you need to consider that. But that's something I'd put in your operating agreements. I'm going to, just because I wanted to mention some of these cases, but, you know, and like I said, there's risk, there's class actions, and everything else. You want to make sure you're compliant. It's not just the regulators. We talk about them. That's not only the only risk point. That's why setting this up and being so certain as to its compliance is critical. Next slide. So how do you do this? I think, you know, getting down to the brass tacks, we talked about the operating agreement. How do you set up your compliance? So one thing I would do is this. First, I would have training. Now, everybody says, okay, everybody stop yawning, right? Because training is like, yeah, that's the answer to everything in life, right? And yeah, like everyone's just going to hear the training and act exact in accordance with what you told them to do because no one ever breaks the rules, right? I know, it's, you know, fairies and pixie dust, right? But the point here is this, and I think it's critical here. A lot of times, especially when you're talking about realtor affiliates, they actually don't know the rules. Like, they really, truly don't know the rules. And you still find realtors who say the CFPB doesn't apply to real estate agents. So number one, you gotta kind of dispel them of the you can do whatever you want cowboy, right? So I think having the training makes it real. The other thing is so critical, it reminds people. Don't underestimate that. Am I saying they're all going to follow the rules to the T and the letter? No. But I think if someone just trained you and just told you couldn't pay for referrals, you probably wouldn't take your iPhone out, record it, and send it in an email to your 100 closest friends where you gave $20 to the realtor for referring you a loan. I think you probably wouldn't do that if someone had just told you can't. You probably wouldn't videotape and create evidence of it, right? So sometimes, and I'm not suggesting it's okay to do it anyhow, just don't tape it, right? But my point is that reminder makes people conscious of the do's and don'ts so that 3 years from now, when you're reminding everybody every year through automated training that reinforces these concepts of what you do and can and can't do. And remember, it's also the thing that's the little things that get you in trouble. I always say to people, you know, sometimes it's okay to leave to only take 90% of the juice out of the lemon, leave the 10%. That's the 10% that gets you in trouble. It's the person who says to you, oh, you know, yeah, but my brother-in-law is is a loan officer, and I really feel like I've got to give the business to him. And well, sorry, then you're not going to get this house unless you use our guy. You know, let that go, right? And sometimes those reminders that you can put in training, like this is where the risk is, guys, and this is where this whole beautiful thing we built that's now making a lot of money is going to get blown up because you're going to do something stupid and overreach. Sending that message consistently every year by requiring training on every level at every place in the affiliation is really critical to reminding people and keeping people focused on the compliance enough so that the entity continues to exist. Have your policies and procedures created not just out of some form from whichever website, but also something that's literally been unique to a JV, that creates policies that apply both to affiliates, both to the JV itself, and that take into account the unique situation of a joint venture. Don't just take the parent policies, change the name, and say, well, these are mine now because we didn't want to pay for another subscription, right? It's penny wise, pound foolish, right? There's a lot of resources. Avoid improper incentives. I see a lot of times where, the real estate company puts incentives in place to not necessarily the agents because they can't because they're independent contractors, but to managers to make the agents, again, you're setting up incentives for people to do things that they shouldn't do. Avoid it. I mean, you have to think of these things. When you create incentives, I mean, I hate to name a company, we've all heard it though. It's the Wells Fargo problem, right? You create the wrong incentive, the bad thing happens, guess what happens to you? Exhibit A, right there, right? I mean, what was it, the commercial that I just saw it in some during like a hockey game or something where they said, established 1888, reestablished 2018, something like that. You have to reestablish yourself now. Great, perfect. I'm sure they love that. Sorry to pick on somebody here, but that's what improper incentives do. Don't create them. Even if you can, it's not always a good idea. There's a ton of money to be made. Leave a little bit of leaf on the tree, right? Enforcement, have enforcement mechanisms. I mean, if people are doing the wrong things, take action. Because that one realtor who, might be giving you some business is putting the entire thing in danger. And that's what happens when and there's perfect examples of this with the CFPB. There was a case, where there was we still don't know who they were. There was a lender that did have a RESPA violation. They took actions and they fired the LOs. I think there was the same case for Chase and Wells again, hadn't taken any action and knew what was going on, and they both got fined like $36 million, okay? Because the CFPB said, hey, you guys knew what was going on, you didn't do anything. You just said stop. You didn't force anything. These guys actually fired them. Their name's not going to be mentioned. They're not getting a fine. See you later. Right? That's the difference. That's what they want to see. Monitoring, I skipped that, and that kind of goes with the enforcement. Have a plan to reach out to your customers and make sure as part of it, not just that they're happy with the experience they're getting, but that they feel like why wouldn't you ask in the right way, done the right way? Hey, did you feel like you had the opportunity to select anybody you wanted? Yeah, I did. I felt like I could select any company I wanted. Are you glad with this decision made? Yes, I am. Not only does that enable you the ability to take enforcement, right, if you have a problem, what better exhibit A to your letter back to the regulator when they say, well, we think you're steering and people don't have a choice. Really? Because let's see, I monitor and I send out surveys to all my customers, and 97.3% of them come back and said, yeah, I felt like I had a choice. Seems to kind of counteract the assumption you're making that they didn't, doesn't it? And for in my example, 2.7% that don't, we took enforcement action. We called up, we followed up, we found out why they didn't, and we took matters and addressed it. Now what are you going to do? That's one where you kind of fold your arms and pick your feet up on the chair and, smoke your cigar if you like to, right? You're good. You have huge confidence there. And you're able to say this in your story, because we are creating a story here for that day when you get that letter or that regulator, because it's going to happen. Is now you can say, I didn't just do the minimum. I went way beyond. Now you can be confident of the business model you've developed, not just for the short term, but the long term. That's the key. That's where your long-term business value is. Next slide. So a lot of these are kind of, we talked a lot about this stuff, I think through the various different slides here, so we can kind of jump to the next one, I think. So we are concluding the webinar. Thank you. And I just wanted to quickly tell you, Leslie, if you have interest in this, it's a product that SEQ put together called JVerify. It does a lot of the things, actually all the things we talked about today. You could certainly, find other resources, try to do them yourself, but it is a unique solution specifically creating a compliance program for joint ventures. It actually is supported by a legal opinion that basically it says if you do these things, and it's a legal opinion from a law firm, that you will be okay. And to the extent when you're looking at investors and you're trying to create value and get people interested in doing this with you, having a legal opinion in an environment like this that specifically says you do this and you're good, that's if nothing else, it's a good thing to tuck under your pillow when you go to sleep at night, right? It provides all the things we talk about: policies, monitoring, training, advertising reviews, and there's annual reviews to maintain compliance. And the cost is pretty reasonable. So if you're interested in that, you can talk to Leslie. I just wanted you guys to know that it was out there. So is there any other questions?
Yes, there were two more questions. Hold on one second. Can the revenue that is derived at the JV level compensate individual real estate agents in a compliant manner? Could agents participate as shareholders?
So this is one of those I'd really prefer to do offline, but in the right way, and there's just a right way, which I don't want to necessarily go into here, it's just a little too involved. There is a way I think it could be done, okay? But there's more that has to be done there, a lot more. I think it could not be every single realtor. I think there's a way I would set it up through, and you definitely want to get legal counsel. You would want to set this up through a holding company with a certain number of members. There would have to be rules of membership. There would have to be enforcement built-in mechanisms to ensure, and this is the key thing, you have to ensure that there's incentives there, that the realtors themselves are going to act like good people with halos over their heads, right? If you can create the incentives, I'm not just saying, go create a holding, put them in there and all good. No way. That will never work. I wouldn't agree with it. Like whatever adjective I want to put on that, it's no, right? But if you set it up with the right incentive program, with the right compliance program, with limited people, a few limited people, through the right type of corporate structure, I think it's possible, okay? It's just too involved to answer here, but I wouldn't say impossible. How's that? But I mean, you need to put in a lot of layers of protection. I think I know exactly how to do it, but it takes a little bit more work. And I want to convey one thing. I would not say in any shape or form, okay, every realtor is now going to get it, and I'm going to set it up, one company with one realtor without the broker, and that's going to be it, and we're just going to have our own separate deal. I would not do that. I absolutely not on that deal. But including a couple of the big producers in a holding company that's also owned, if there might be a way to do that.
Okay, and there's one more question. In a JV, can an owner take their percentage of the JV's profits and share a portion of it with their firm's employees as they desire?
It's something that I would avoid. There's more I need to answer that question. What I mean by that, are we talking an ESOP? Like if you set up an ESOP, of course you can. Is it being done with a couple of people through a holding company in a much more structured? Yeah, I mean, is it that you're just taking out money and giving it to them because they refer deals every? There's got to be a huge structure put in place. So I would ask that person to probably just contact me directly. It's too hard a question to answer sort of in a vacuum. I mean, what I will answer is this. Don't just take the money and give it to people because they've referred in business. You're going to end up in the same, remember, we talked about this, creating the right incentives. You want to create an incent compliance. So if you're going to do something like that, is it possible? Maybe, yes. But I want to know, what kind of business are we talking about? Is it a real estate company where you're going to now pay the realtors? Because that may be an issue. Is it the loan officers? Well, you've kind of already got that built in. Is it the parent company paying for the employees that send things over, which actually they might be able to do under RESPA? So I need a little more, and I've just asked that person to contact me. I just need some more information.
Sorry, he just wrote in. It says the employees are not realtors.
I still need to know a little bit more. This is not the right question to give privileged, right? I mean, this is not legal advice. This is that the old adage of your disclaimer which says this is not legal advice. It's a webinar. I'm kind of giving it to you here. That's a legal advice question where somebody has to give me some real particulars to talk about it. It's not impossible depending on the situation, but I'd be really, 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 really careful. Don't do it without a lawyer. How's that?
Sounds good.
All right. Well, everybody,
so with that,
turn it back over to you, Leslie.
Sure. So thanks, Ari. This was great information. Again, if anyone wants to learn more about JVerify, you can contact me. My information's on the screen. Also, if you're interested in just slides or the recording and the slides, you can also email me and I'll send them out to you. And anything else we can help you with, we're always here. So thanks so much for participating. Don't know if anyone on the East Coast is going to start watching the England match. So whoever you're rooting for, good luck. And we'll talk to you soon. Thanks again.